Right now, somewhere in a bank, your money is sitting safely in a vault. At least, that's what most people think. The truth is far more interesting and honestly, a little unsettling because the moment you deposit your money into a bank, it doesn't just sit there. The bank immediately gets to work with it. And what it does next built the entire modern economy, but also caused some of the worst financial crashes in history. Here's what most people imagine. You deposit $1,000 into your bank account. The bank puts your $1,000 in a vault. It sits there safely. When you want it back, they open the vault and hand it to you. Simple and safe. That's the picture most of us carry around in our heads. Now, here's what actually happens. You deposit $1,000, the bank keeps a small percentage, maybe 10%, as a reserve. That's $100 kept on hand in case you or other customers want to make withdrawals. The other $900, the bank lends it out to someone else, a person buying a car, a business expanding, a family getting a mortgage. Your $1,000 deposit just became $900 of someone else's loan. And here's where it gets wild. That person who borrowed your $900 spends it. Maybe they buy a car, the car dealer receives $900 and deposits it into their bank. Now their bank keeps 10%, $90, and lends out $810 to someone else. That person spends $810, it gets deposited again. That bank lends out $729, and on and on and on. Your original $1,000 deposit has now multiplied through the banking system into thousands of dollars of loans and deposits. This is called fractional reserve banking. Banks only hold a fraction of deposits as actual cash and lend out the rest. With a 10% reserve requirement, that original $1,000 deposit can theoretically generate up to $10,000 of total money circulating in the economy. Banks are literally creating money, not by printing notes, but by making loans. In fact, most of the money that exists in the modern world was created this way, not by governments, not by printing presses, but by banks making loans. Around 97% of all money in existence today was created by commercial banks through lending. So how does the bank actually profit from all this? Simple. The interest rate gap, they pay you a low interest rate on your savings, maybe 1% or 2%. Then they lend that same money out at a much higher rate, maybe 5%, 6%, even 20% on credit cards. The difference between what they pay you and what they charge borrowers, that's the bank's profit. It's called the net interest margin. Your savings account earns you almost nothing. Meanwhile, the bank is using your money to earn far more from someone else. And lending isn't the only way banks make money. They also charge fees, account fees, overdraft fees, transfer fees. They invest in financial markets. They sell insurance and financial products. They offer mortgages, business loans, credit cards. Big banks are essentially enormous financial machines that use your deposits as their raw material and spin them into profits through dozens of different channels. But here's the massive risk baked into this whole system. Remember, the bank only keeps a fraction of your money on hand. What happens if everyone tries to withdraw at the same time? The bank runs out of cash. It literally doesn't have enough money to pay everyone back at once. This is called a bank run, and it's happened throughout history, most recently during the 2008 financial crisis, when people panicked and rushed to withdraw savings from failing banks. To prevent total panic, most governments created deposit insurance schemes. In the US, it's called the FDIC. They guarantee your deposits up to $250,000. In the UK, it's the FSCS, which protects up to £85,000. In Europe, it's up to €100,000. This means even if your bank collapses completely, the government will pay you back up to that limit. It's a safety net that keeps people from panicking and pulling all their money out at the first sign of trouble. So what should you take from all this? 3 things. 1, your money's not sitting in a vault. It's being used the moment you deposit it. 2, banks make serious money from your savings while paying you almost nothing in return. This is why understanding investing matters. Your money should be working harder than a 1% savings account. 3, the whole system runs on trust and confidence. The day people stop trusting banks is the day the system cracks. It's happened before. It'll happen again. Banks are one of the most powerful institutions ever created, and most people hand their money over without ever asking what happens next. Now you know. If this helped, hit like and subscribe. New finance video every week, always explained simply.